Hello, this is Stephen Cooper, founder of OnlineOption.com. Since 1999, we've been teaching folks how to profitably trade stocks and options using clear and common sense approaches. Today, I'd like to show you a simple method of finding low-risk, high-reward trades. Trades like these can be found virtually every market day, and with a little practice, you'll be able to identify these trade setups and take advantage of them. First of all, let's go into the members area of OnlineOption.com to resources and to charting. I'm going to show you 4 different charts that demonstrate the principle that we're most interested in. We could call them trading off of support. First company we'll look at is one that you've no doubt heard of, Caterpillar. I want you to notice that today's intraday bar is right at $110 a share. Caterpillar for the last 2 months has been trending upward strongly, and with the broad market down today, Caterpillar too has taken a tumble, and at the moment it's down $1.38. As I'm recording this, we're still in the trading session. Now 110, 105, and 100 are all very important numbers. I have discovered that as price breaks up through $100 a share, it typically goes to 105 in short order, days or a week or so. Should it break through 105, very typically it will go to 110. If it breaks through 110, typically it goes to 115. These natural levels of resistance, which when price passes through them become support, are great places to put on new trades. So the way I would handle this is to see that Caterpillar has dropped down today, and the intraday low, as you can see up here, was 110 and 33 cents. 110 is now support. If we were to go long right now, either buying the stock or buying at the money fairly near-term options expiring in 1 to 2 months, we'd have the opportunity to take advantage of any price rebound up off of 110. The next resistance level is up there near 115. Why this sort of trade has low risk is because we have this very handy level of 110 support on this particular chart to use as our protective exit. So let's say we put on a trade today. We either buy the stock at 111.45 or we buy a call option, which is going to be 5 to 10% of that in cost typically. We then set 110 as our exit. So with stock, we'll just have a contingent order that should Caterpillar, after we've entered, drop below 110, we are out. So we're risking $1.45 a share, which is about 1%, a little over 1%. Very minimal risk. If we're trading the options, we would set a contingent exit. That is, our option position would be closed if Caterpillar shares trade below 110. Again, we'd have very low risk and a high probability of making some gains here in short order as Caterpillar moves up toward 115. Next chart is CLB. CLB is one that we've traded just a week and a half or so ago on this big break here that you can see right early February. I used this same principle then. We noted that CLB dropped down and was finding support at 105. So I told the members of OnlineOption.com that we would enter long CLB should it break up through 110. So we got in on this day. The option that we chose had a premium of $6. Later in that same trading day, the premium was up to $12.20. It had more than doubled. So we set a trailing stop at 20 cents below that 12.20. It turned out that CLB did move down later that day, and we exited the trade at 12. So we had a 100% gain in one day. Now, once you have such a nice experience with a chart, it's hard to let it go, and so we're still looking at it. CLB moved into a bull flag. That's not our topic today. We'll talk about that in the future. And then 3 bars back, it broke up through 120. Today, CLB backed down to 120, and here we have a nice support level. This is another high probability, low risk trade that would be short term. A day or 2 or 3 is all we would expect to be in this trade. So we would go long CLB right now, buy the stock at 120.67, set our protective exit once that position is opened at 120. Or we could use an at-the-money, fairly short-term call option and make a contingent exit order, after we've gotten into it, of course, to get us out should CLB drop below 120. Now, once in a position, when they're short-term like these are that we're talking about today, if there's a bit of profit, and I'm talking 20%, 15-20% at least, I'm going to start guarding that profit very stringently. Again, especially on a short-term trade. The next chart is CLR, Continental Resources. You're probably getting the idea by now. Continental Resources, though not as steady as the previous 2 charts, CAT and CLB, that we've looked at, has likewise risen in the last 2.5 months, done very well. It's backed off, and intraday lows today are right at about 175. So we can enter this one looking for a rebound up toward the next significant resistance level of 80 and have very low risk. We would be risking with a stock purchase $1.43 per share, or we could enter a at-the-money near-term call option, again with very low risk, using 75 to trigger our exit. The last chart for today is CXO, Concho. Here's our Concho Resources chart. This one, again, has been going up for about 2 months. And notice this 110. Price accelerated up through 110, backed off, and it's now using 110 as support. Our high probability, low risk trade would be to go long. As price remains above 110, it's just 35 cents above it right now, so not much. We might even wait till the next trading day and make sure after the first hour that Concho is moving up, then enter it and use 110 as our exit. As I mentioned, you can find these trades just about every day. On onlineoption.com, we use a watch list that has been built through fundamental analysis. These 4 charts that I showed you just in the last few minutes were gleaned from that watch list. Took me all of about 4 or 5 minutes to find them, and they're there every day, and with a little practice you'll be able to find these and engage in these trades for high probability, low risk, quick return. Good luck in your trading, good success, God bless.